Welcome to Cafe Mutual YouTube channel. Friends, we all know that there are active funds and passive funds. And within passive funds, there exists a category called factor funds, which simply follows a predetermined formula to select stocks. The best part of factor fund is that being a passive fund, it can actually outperform the broad-based index funds. So to know more about factor funds, today we have with us Arun Sundaresan, Head ETF Nippon India Mutual Fund. Arun has close to 2 decades of experience in financial services industry. So without wasting time, let's welcome Arun and learn from his wisdom. Good evening, Arun.
Good evening, Nishant. Glad to be on this channel.
So Arun, so my first question to you is about factor investing. So can you take us through the concept of factor-based investing?
Sure. So, factor investing, some people call it smart beta, or by any other name you may want to call it. So, basically, it's a strategy of investing where you focus on select drivers of returns. So, what could drive returns? Sometimes it could be between asset classes, different asset classes, or sometimes within the asset classes also, what drives returns, and you focus on them. See, for example, if it is multi asset or different asset classes, you take macroeconomic factors like economic growth, real rates, inflation, and then see, depending on how each of these factors move, what could impact and which asset classes are likely to do well, right? So that is between asset classes. So likewise, if you take a particular asset class like equity, again, different factors or what is called a style exposures can work at various points in time. For example, value could work at some point in time, momentum could work at some point in time. There are other factors like quality, even lower volatility. So if you focus, if you select, if you choose to focus on a or a set of factors and then build a strategy around it, these are called factor indices or factor based products. So makes for a very very interesting investment option.
So, Arun, what are some key advantages of factor-based index funds, and what are some innovations that this category has brought to the MF industry?
So as I mentioned, there are different factors. I could name at least 8 of them: value, quality, momentum, growth, dividend yield, alpha, low volatility, equal weight. And now, if you have 8 factors, and then you can possibly think about combining various factors, a two-factor model, a three-factor model. For example, you can combine alpha with low volatility. You can combine momentum with quality or various combinations, right? So you already have various factors. I mentioned just 8 of them, and then combinations, right? Then you're talking about a whole lot of possibilities in terms of what approach you can have. Now, this kind of innovative, or rather the possibilities, may not be there on the active side, where schemes are categorized largely based on market cap, and within some sector thematic you could have some variations. Whereas when it comes to the passives, these kind of factor investing or the smart beta products, there can be various combinations. So this is one way of looking at it, where I'll have one factor or multi-factor. The same principle I can extend it over different parts of the market. For example, I can choose Nifty, and within that, say I'll be value. The same thing I can say that I'll look for value in mid cap. So those two become two different strategies, right? Even though it is a value style focused approach, but the underlying becomes different. The methodologies can be different. So that makes all these products very different, unique, and very very interesting. It can target a specific investment need, but the core idea of the factor-based or smart beta investing is to focus on a specific driver of return. If I'm of the view that value is what is going to drive returns, I might as well choose a value strategy or a value factor product, right? So it allows me to specifically focus on a particular factor or a set of factors. So
Mm.
that makes it, very, very interesting.
Mm. So, Arun, good that you mentioned value, and value has been, I mean, they made a strong comeback in the recent times. In fact, Nippon India Mutual Fund has Nippon India Nifty 50 Value 20 Index Fund, which is a factor fund. So, can you take us through the methodology of this fund?
Sure. So the Nippon India Nifty Value 20 Index Fund, as the name itself suggests, it selects the 20 value stocks from amongst the Nifty stocks. So Nifty, all of us know that there are 50 stocks. In a way, more or less, Nifty would be a static index in the sense that these are the top 50 companies by market cap. There will be changes over a period of time, marginal. A few stocks would drop out, a few stocks would add, but end of the day, these will be the top 50 stocks in the country, right? So
Mm,
that is Nifty for you.
mm,
Against that, what Nifty Value 20 does is every year, and by December, that's a rebalancing time, it looks out for value. And I'll tell you what they mean by value here, right? Based on value, whatever is value at that point in time, identify the top 20 stocks
mm,
within Nifty as a universe, which
mm,
becomes the value stocks at any point in time, right?
mm,
So that's the concept. Obviously, any index fund is rule based. So it is upfront decided what is the meaning of value. As
mm,
far as this strategy is concerned, there
mm,
are four metrics that are used. So one is return on capital employed, ROCE. The other one is PE, price to earnings ratio, price to book, PB, and dividend yield. So
mm,
there is a weightage given. A 40% weightage is given to ROCE, 30% weightage is given to PE, 20 to price to book, and 10 to dividend yield. So based on this methodology, whatever is the top 20 stocks within the Nifty 50, that becomes part of the index and therefore the fund.
mm,
The best part about any index fund, and even in this Nifty Value 20, is that there is no emotion attached to the entire investment process, right? So, therefore, the changes that can happen between one year and the other can be significantly different. In fact, just as a point of reference, last year, the financials weight, banks, financials all put together was 0%. That is zero, nil. You cannot find any active fund where financials is zero. Any
right.
active diversified fund, so to say, you will not find because financial is a heavyweight as far as the index is concerned.
Mm,
Almost 35-40% weight. So fund managers usually will have slightly less underweight, slightly more overweight, etc. But no one will take an extreme call. Whereas index funds and particularly the NV20, depending on what is value as defined, will actually go extremely, it may even go to zero, it may go to a very high level. What is value, you get that, right? So this kind of dynamism, this kind of uh, the change in the underlying portfolio to reflect value at any point in time is actually an USP of this NV20.
okay. So, Arun, you mentioned ROCE, PE, dividend yield. So can you tell us in detail that PE should be lower or higher? I mean, ROC should be lower or higher. On what basis you give weightage?
Yeah. So generally, the concept of value investing is identifying stocks. I
Mm,
wouldn't say they are trading cheap, but they are trading at a lower level than what ideally their intrinsic value is suggesting. So basically, it means that they've not performed as well, and therefore, in the future, possibly they're likely to do well. But at
mm,
the same time, it should be quantifiably justified in the
mm,
sense that it is generating higher profit, but it is trading lower than
mm,
what it should be. The earnings are good, whereas the price is lower, meaning the price to earnings ratio is lower,
mm,
right? So that also makes it a value. Likewise, the book value is good,
mm,
whereas the price is lower than where it should be, therefore lower PB. Dividend yield, the company, the stock is actually paying higher dividend. as a percentage of the price, right? Which means that the dividend yield is high. So all these metrics, in a way, are a reflection of the company doing well, profits, your earnings, etc. At the same time, price being relatively lower. So
Okay.
therefore, you combine all of these four factors. ROCE is a reflection of profitability, return on capital employed, 40% weight, price to earning, lower the P, the better. So that has a 30% weight. PB, lower the PB, the better. Dividend yield, higher the dividend yield, the better. All these are a combination of an indication of the stock doing reasonably well in terms of profit and earnings metrics. At the same time, price is relatively lower, especially when it compared to other stocks in the index. So relative value, and therefore you identify quantitatively on a rules-based approach and then select the top 20 stocks.
So Arun, Amphi data shows that Nippon India Nifty 50 Value 20 Index Fund is the second highest fund in the factor index category. So what has attracted investors towards this fund?
So we have two offerings, NV20 on the index fund as well as on the ETF front. The index fund is close to 600 crores as we talk, reasonably good in terms of size, and it's been successful. I would say one of the reasons why it may find acceptance or investors like the strategy is one, fundamentally, the way it is structured, as I explained to you, against a static Nifty, right? More or less 50 companies, you get more or less the same kind of stocks every year. Here is something where within Nifty, so you're not straying away from the large cap or within the large cap, the best companies. But even within that, you're trying to identify 20 value companies, and this also changes every year, right? So there is an automatic dynamism. You don't have to worry. You just invest into the fund. After 1 year, something which has run up and it has crossed is what should be a reasonable value, that goes out of the index, and what is to be value stock, that comes in, right? So that's number one. So fundamentally, it might appeal to many investors because it's kind of I was a one stop. I do it, I forget it, and at every point in time, it is value, right? So that is something very fundamental. Number one. Second, the strategy has done phenomenally well over a period of time. In fact, the last 15 years, 10 out of 15 calendar years, this has beaten Nifty. And on an average, it has generated a 4.8% kind of a alpha when compared to Nifty. So you're getting the best of Nifty in a way, right? Out of 50, you're getting 20 and value at any point in time. And historically, it has generated this kind of return. And that's, kind of too good. So just to convert this in terms of numbers, if you had invested, let's say, 1 lakh over a period of time, 15 years, in Nifty, it has become 8.8 times. Whereas in value, it has become almost double of that, almost 16.4 times. That's the kind of returns that it has generated. And even on a rolling basis, the last 1 year, for example, 1 year return or a 3 year return, almost 75, 77% of the times, it has actually beaten Nifty. So if you're an investor, you want to play the market and you don't want to spread yourself. I don't want to go into mid cap, small cap. I don't want to take too much risk. I want to do in the large cap, be safe. A lot of people prefer Nifty, right? Nifty is a very, very popular option. Here is a product where you invest almost like Nifty. In fact, the correlation between this product and Nifty is very high, meaning it performs more or less like, Nifty goes up, this also goes up a little less, little more. But eventually, over a period of time, because of this value orientation, it tends to generate, the returns that I just mentioned. So that's been the historical evidence and experience. So therefore, you get the best of kind of Nifty in a smart beta, in a factor-based strategy, and that could appeal to a lot of investors.
So the 20 would be in the equal weightage structure?
No. So the weightages can change depending
Okay.
on how these metrics
Hmm.
because of the weightages, right? There is a capping of 15%. No single stock can be more than
Hmm.
15%. That's the only weightage. But otherwise, the weights can be. It's not equal weight. Purely based on these quantitative metrics, whatever comes through, that's what you have.
Okay. So Arun, one last question. So while the tracking error of the fund is very less, the tracking difference is on the higher side. So what's the reason for this?
So index fund, obviously, depending on whether it's direct or regular, will have an expense ratio.
Hmm.
Tracking difference is nothing but purely the difference in return of the strategy
Hmm.
vis-a-vis the index.
Hmm.
And to a large extent, because of this expense, you will see the
Hmm.
difference, right? So
Hmm.
that is what, suppose if the expense of the fund is, let's say, 70 bips, so you
Hmm.
will typically see a tracking difference in that range.
Hmm.
Okay. So that's tracking difference. Tracking error is a different concept whereby you see the difference and how volatile that has been. So you take the standard deviation of the difference. That number for this fund is only 0.08%, which
Hmm.
means that it is very efficiently tracking the underlying index. So both these numbers, tracking error as well as tracking difference for this strategy is very, very low.
Okay. So thank you so much, Arun, for your wonderful, insights on factor funds and valuable time. Thank you so much.
Thank you, Nishant. Pleasure meeting you. Thank you.
And finally, I thank each one of you for being such a wonderful audience. Have a great day at work, guys. Bye.